Thank you very much for attending. Been quite a good day in markets actually. We've had some movement in the pound with the UK unemployment and wages data sort of push around there. We saw a record high on Wall Street last night. Not really assisted, but despite the new iPhone release from Apple. So a few things going on, but we're not really going to be looking at current market affairs per se at the moment. We're going to have a little look specifically at how to determine a trend, or at least three very popular ways to determine a trend. So what we're going over today? Well, it's going to be what is a trend, why it matters. These three most common tools, you may have been wondering what those are. Well, it's going to be Dow theory, moving average and trend lines. Do these tools work? Obviously a pivotal question, and even more so, how exactly do we start using them? So the idea with this webinar is that I'm a big fan of detail, but I don't want to be harping on for hours and hours. Some of these webinars can last way too long. This is hopefully going to be a pretty kind of quick digest where you can just take something away without having to commit half your day to it. So let's get into it here. What is a trend? Well, obviously this is all fairly basic stuff. You don't have to excuse the basicness of this, but still sometimes it's good just to remind yourself. Price is when the trend is going in one clear direction. So in this example, obviously, we've got a nice little uptrend going on. When we're not in a trend, what is it? Well, it's a range. So when a price is not going in one clear direction, that's what a range is. In other words, it's going sideways. So you can say it's going a direction, it's going sideways direction, but that's not too helpful when you're using trend following techniques to determine when to place your trades. So you can see here obviously that maybe the price makes a new high, but it quickly comes down and makes a new low. New high, then new low again. So part of this is determining what environment we're in. And you may be asking, why does it matter what a trend is? I look at a candlestick pattern, I look at a momentum indicator, an oscillator, when to enter and exit my trades. Who cares what the trend is? Well, because going in the direction of the trend increases your chance of having a profitable trade. I'm sure you've heard the trend is your friend many times, but why? It's actually quite logical when you think about it. A trend only reverses once, but it continues many times. So you get many pullbacks in a trend. Obviously, price doesn't go vertically upwards. It goes up, it starts coming down, and then obviously you always have that question, well, is it coming down and is it reversing? Or is it coming down just for a little bit to offer a dip for us to buy and it continues going higher? Well, those little dips and continuations happen a lot more often than the reversals do. So while the market may spend a lot of its time in a range, like on that previous trend we looked at, and only a small amount of its time in a trend, once it's in that trend, those continuations are more frequent than the actual reversal. So when you're in a trending environment, betting on it ending is just a less likely result than betting on it continuing. That's the logic, basically. But why is this not obvious to all of us? Well, because when you get told when you first start investing, Warren Buffett logic and everything, buy low, sell high, that is fine for investing. When talking about the stock market, buying a stock with a low valuation over time generally gives you a better return than buying a stock with a high valuation. We're not talking about that. We're talking about trading, and we're talking about trend trading, and that's why this buy low, sell high logic doesn't really work. What we're looking to see is a market that's rising, and we want to make the bet that it's going to continue rising, or a market that's falling, we want to make the bet that it's going to continue falling. So apologies again if that's a bit self-evident to some, but obviously to newer traders, that's a bit of logic that doesn't always come out so clearly. So getting more to the meat of it now. And I should have mentioned that obviously at any point, if anyone has any questions, certainly feel free to fire them through to me. I'll try and be as clear as I can, but if I'm not, obviously just call me out on it. Or if there's something else a bit on the left field that you wanted to ask, probably I'll try and address that at the end of the webinar. So there are many ways to identify a trend, but I'm just going to concentrate on these three. Basically because of all the different techniques I've used, I find these to be the most intuitive. So why three, you ask? Why not just one? Well, it's like a lot of technical tools. One by itself doesn't really do the job. I would say, if I was throwing around random numbers that haven't actually been proven, but I would say something like if you just used Dow theory by itself, say you're using no theory, you're just buying randomly, you've got a 50-50 chance of getting the direction right. If you use Dow theory, I would say that probably just by itself and nothing else, probably edges up to 55%. If you incorporate moving averages as well, maybe it edges up to 58. Moving up to trend lines, maybe it's 60, 62, 65%. Their favor has slightly shifted towards you. So that's all this is adding a few tools just to make it slightly more likely that you call the right direction. You're never going to call the right direction the whole time, but a few things put together can work. So let's jump across to the trading platform here. It's the LCG trader platform. Now I've already got a few of these indicators on here, but let me go back to basics. So this is the trend, this is the chart as we normally see it. This is removing everything. It's just the candlesticks. Now I'm going to assume a bit of basic knowledge on a candlestick chart here. This, for what it's worth, is the cable chart, the British pound against the US dollar. Again, it's been one of the nicer movers today. We've actually hit a one-year high in this chart today. You can see it over here, clipped up. This was this time last year. We bounced above this high, but it's not that for that reason I've chosen it. It's just because we've actually been in an interesting environment to talk about trend trading. Now, why the weekly chart? One, because it tends to give, the longer the time frame, it tends to give a clearer signal than on a shorter time frame. So the trade-off here is that longer time frame signals tend to be more reliable. They just don't happen as often, so you don't get as many trading opportunities. Shorter term signals happen more often, so you get more opportunities, but they're not as reliable. So it's a trade-off, and everyone has to find their own balance. The second reason I've chosen the weekly chart is because in my own personal trading, I tend to take my trading cues from a daily chart, i.e. my signals to enter a trade from the daily chart. So I'm really judging the trend on a weekly chart on the higher time frame. Now, I should reiterate for this particular webinar, for this particular topic that we're discussing, we're not talking about entry signals. Now, I'm hoping that if this webinar gets a little bit of success, and even if it doesn't get some hot fire success off to start, I'm hoping this is going to be the beginning of a few, and some of those later webinars will discuss entry techniques, exit techniques, trading signals. But this is almost the first part of the puzzle before you get to that. This is how to determine the trend, and again, going back to the slides we were just looking at, why do we want to determine the trend? So that we're trading in the same direction as it and putting the probabilities in our favor. So, fairly clear cut, right, with the benefit of hindsight that this was a downtrend, but how did we know at the time that it was going to develop this way? We didn't, but there was a few clues along the way to help us in which direction to go. So I'm going to add one indicator to the screen here. You don't need this, but it definitely helps, I think, when you first start, and that's fractals. So what it's talking about here, it's talking about 5 periods. So it'll be more clear when I actually click OK. I basically don't change any of this. You'll see that the top ones are red, the bottom ones are blue. So looking right here at the top, it's less clear here because you have many, many candles either side of it. But the idea is that here is the top candle, And for it to justify this little red fractal on the top, there has to be two candles to the left of it and two candles to the right of it that are lower, that haven't made higher highs. So it's the highest candle for the prior two periods and for the latter two periods. So this doesn't appear when this candle closes, it appears two candles later, once we've had two lower days that haven't eclipsed this candle's high. Equally for a low, same thing. So, you know, this one, for example, we've had 2 days with a higher low, and we haven't taken out this low here. Equally on the left-hand side, we've got the same. Why would we want that? Well, it's basically showing us the swings of the market. And so going back to Dow theory, you know, there's various components to Dow theory. One of them is that the you know, the relationship between the Dow Jones Industrial Average and the Dow Jones Transport Average. We're not talking about that right here. We're talking about the kind of foundations of all that, which is highs and lows in the market, swing highs and swing lows. And so these are basically denoting these swings. So if we go back in time to say before that whole trend developed, what was happening here? We were basically in an uptrend, but then something started to shift. So this was the uptrend that we just saw, and then so we had, this was a higher low, this was a higher high, this was a higher low, this was a higher high, but then we didn't make another higher low. We made a lower low. We took out this low down here, and the market started rolling over, and eventually down here we selling anymore, because it's not fitting that definition of a downtrend, the lower lows, lower highs. In fact, now it's fitting more of a definition of an uptrend. Again, there's other variables to consider, the moving averages, etc. to come, but just on the Dow theory alone, maybe we want to be buyers now. So actually, what then does happen is that we do put a higher high, then a higher low, another higher high, another higher low. So this is all good for the buying environment. Obviously, towards the end of the trend, when you're expecting that next higher high, at some point in time, it won't happen. Here, I would, you know, I would debate that you'd call this a swing high, because it's really just a large consolidation where multiple weeks really had the same trading range. Here is the signal where we put in the lower high, and actually this is a great week to have interpreted the market, because you go for that lower high and then suddenly you take out the low down here, you've made a lower low as well. And so now the environment's different. We've taken out this low, we make a lower high, lower lows. This is a downtrend environment again. Lower high, lower low, low low, and it's only down here where this time, you know, over here where we kind of made a small lower low, but it was kind of flat. Here we made a higher low. That was our first sign of weakness in the downtrend. You know, obviously we don't get the signal there, but we get it a little higher up, and then we make a higher high, higher low, and then obviously this is the pound against the dollar, so this is Brexit territory. We make a what's interesting to me here is that actually the clue about what was going to happen to Brexit was already there a little bit in the market. Let me just get rid of that for the time being. That actually we'd made a lower low here in the weekly chart. So the weakness was showing up in the market. Now we'd held above this low, so you can see where the market rebounded there off this weekly fractal. But we had taken out this one. And so then what happened, the market flew higher. So, you know, it would have been difficult to trade based on this. You need very wide stops, obviously above these highs. Any stops up here got taken out. Then obviously when the Brexit vote, the Leave vote came in, the pound collapsed. And of course we made lower lows again. And now we find ourselves in this current environment where we put in that flash crash low, and then we started forming into what became more like a range-bound environment, where there was a higher low, so vaguely higher highs, but really it was all just kind of going sideways. And then it's only recently where now we've pushed up and made a higher high, and it came back to that breakout, zone, made the higher low, and we made another higher low recently, and as we speak, as we hit this 1 year high, we're trying to make the next higher high. So you can kind of analyze the trend of the market pretty much with this Dow theory alone, but to my mind it makes sense to add some other elements too. Did have some problems with the sound there. Can everyone hear me now? So I hope you didn't lose me for too long there. Okay, perfect. All right, cheers. Back three. So how long was I out for? Is it did you miss a substantial portion of what I was just saying? Sound gone 12:44. I think it looks like it was only gone for about a minute. Is that right? Lost sound. 2 minutes maybe. Oh, the joy. Oh, the technical joys. Okay. All right, perfect. All right, apologies for that. I think you got the gist of Dow theory. So obviously, number 2 on the list, moving averages. So again, add another indicator on the LCG trader. This time a simple moving average. Change the period to, again, you can use any period you want, but I'll use 20. Same thing again. And then 50. Maybe change the color. All right, so a little extra element now. So going again back to the start of where this trend started to change, well actually, previously we were just talking about the fractals, the higher lows and higher highs. And here was our first warning signal with the fractal. Actually, the moving average, the 20-day moving average, you can see was hugging these lows quite nicely in this instance. It doesn't always do that. Was the first indication. Price dropped below the moving average. So where price stands versus the moving average is one way to use the moving average. The other way is just simply which way the moving average is sloping. So here it's obviously sloping up. It rolls over. The price moves first. The moving average moves later. Here, clearly you can see the moving average is sloping downwards. The other interpretation, particularly when you have 2 of them, is where do those 2 moving averages relate to each other? And I'm sure a lot of you will have heard of the moving average crossover. That's the slowest signal we have, but again, it is a signal. And if a price trend persists, maybe that signal's slow, but at least tells you the environment that you're in. You're in a downtrend in this case. So here, the 50-day moving average, obviously slower to react. It's around here, around the crossover, that it starts to roll over. And again, at this kind of point in time, when you're making lower lows and lower highs, and the moving averages are now facing lower, it's another indication to you that the trend is now down. You want to be a seller, not a buyer. So when do we start to get some clues that actually, you know, it's not a decent time to be selling anymore? Well, actually, again, here you can see that this 20-day moving average kind of did cup the move higher in prices a little bit here. So when we were looking at Dow theory, our first signal was, that was the first signal actually in this case, where it was, you know, it's kind of a double bottom down there, not so much a lower low. But then we got the clue from price moving above the moving average. Then we got the moving average itself sloping up. Why would we not massively, you know, why would you not be perhaps massively bullish at this stage? Well, because the 50-day moving average is sloping down. So that gives you a little bit pause for thought that maybe this is not going to, you know, if you are buying in this environment, you've seen the break above the high, maybe you're not so aggressively buying, or maybe you're being a bit more cautious on where you take profits because the 50-day moving average is still sloping down. That constitutes a downtrend. So you can see actually when we did get this pullback here, this 20-day moving average provided a convenient point in which to buy up in this environment where the moving average was telling us that it's actually more of a kind of not a period to sell, if you're a bit more aggressive, a period to buy. Then again, when the moving average starts rolling over downwards again, and when the price is back below the moving average, again we're entering into this period where it's good to be selling. So during this period of time, the moving average gave you a clue that don't necessarily be selling every rise, every rally here, or selling every breakdown, because we're actually in more of a kind of sideways up period of time. And then once we're back below the moving averages again, they're sloping down. Here's the crossover obviously down here when we've broken up through the lows. In this environment, you're like, well, obviously the price is low relative to where it's been, but all indications are the downtrend's back on. So then we continue below the moving average. You can see it again here. We pop a little bit above the 50-day moving average, but the alignment is still fairly solid. We only rise for a small period of time, hence we aren't able to take out that high here. And again, the price drops pretty suddenly during this big Brexit move, and we're well below the moving averages. So even during this period of time where you get a higher low here, we're so heavily below the moving averages. Again, it's a reason for caution. Maybe when the higher low's been formed, you're not aggressively selling every little rally on the shorter term charts, but you're not really buying because the alignment of the moving average is just so bearish. And then eventually you can see down here that actually the price starts to round out, and again the moving averages start facing upwards. The 50-day moving average is a bit more slow to do so, but you can see actually this 20-day moving average, 20-week moving average, sorry, has been supporting this little rise in the pound that we've been seeing more recently. Yes, we're recording this, hopefully with all the sound. So yes, you will be able to watch this again afterwards. Okay, so now I'm going to add the third element here. So again, quick reminder, back to the PowerPoint here, is trend lines. Now, there are different ways to use trend lines. The most common one is that you use it as an area of kind of dynamic support and resistance, basically kind of showing you when there's a downtrend, you have a trend line through the highs, something like along these lines. Obviously, we're kind of in that kind of area of interest at the moment. Different ways of drawing this trend line. You can have it up here, for example. And then you're basically looking to sell any rallies near the trend line. That's one way of using it. There's been a pretty good example of it recently. I mentioned it in my snapshot video, where you just connect these more recent lows down here. 1, 2, 3, and rally. That's not actually how I use it typically. What I try to do is use the trend line for its breaks rather than the times that it holds. So in this instance up here, it was almost identical to the moving average, where we had, in an uptrend, you connect the lows for an uptrend. For a downtrend, you connect the highs when you're drawing trend lines. In this case, we've connected a few lows here on this weekly chart, and again we can see it's another bit of evidence that it's not really time to be buying anymore. It may in fact be time to start selling. So once this uptrend line's been broken, then you think to yourself, well, now we're in a downtrending environment, at least not an uptrend. I want to be paying more attention to the downsloping trend lines. Now, one thing I turned off, you may have noticed just before, is that we can, in the LCG Trader, it's really quite a nice feature. You get to see it by eye after a while, but you can show the angle. So here you can see that obviously a perfectly flat line has an angle of 0 degrees, and a perfectly vertical line has an angle of 90 degrees. My rule of thumb is that anything more sharp than a 45-degree decline it just makes it very, so if we call it something like that, I think. No, more like that. This is probably as sharp as you want it to be on the decline. So this particular example down here, where we're connecting this fractal high and this high here, it's a very sudden move, but it just makes this, when this trend line is this sharp, it makes it less reliable. Nonetheless, we do get a little indication here that maybe there's a bit more buying momentum in the market rolls over one more time. So again, using the trend line by itself wouldn't be the perfect buy signal here. You've got to consider the fractals, you've got to consider the moving averages, all pointing to a downtrend. But it's a little bit of an early indication that the trend is weakening. Then eventually, when you get a slightly more mild looking trend line here, you can see that it actually plays out quite well, because you have this break of the trend line, obviously push up to the moving average, down to the other moving average, and this broken trend line was resistance. When there was a downtrend, it becomes support in the uptrend. So now you flip it around, you think the downtrend has been broken, we're now in an uptrending environment. Again, this is a fairly ugly looking uptrend line to me. It's too steep. Here you got the 58 degrees, you can see it's too steep really. You want it to be more like nothing steeper than 45. So actually when we adjust it to the next few fractal lows here and draw our trend line based on them, here you can see that in combination with the analysis we've already done on the moving averages and the fractals, the trend line breaks. So then we've broken out of the uptrending environment, we're now into a more of a downtrending environment. So we start off with these two highs here, and then we maybe move on to having something like this as our kind of backdrop trend line for the fact that we're now selling, we're in a selling environment. And it's only when we get down to here that again we have perhaps the earlier signal being the higher low, and then at the same time this signal here, which helps us get that higher low fractal, is when we get the breakout through that downtrending trend line. So we're obviously we don't know down here that the trend is ending. We only know once the price is higher and give us this signal via the moving averages, via the fractals, via the trend line. So this is not this technique in knowing when the trend has changed. You can't perfectly pick this top of an uptrend and perfectly pick the bottom of a downtrend. It's just knowing that critical juncture when the who's got the power. Is it the people buying or is it the people selling? At the very top, it's still the people with who are buying have all the power. It's when does that balance change? And this is what some of these indicators are showing you. And here, the balance has shifted when this trend line breaks to the top side. But again, so now we're in an uptrending environment. We're looking for the break of the rising trend line, and that's what I mentioned before. Is that we had that break of the low. We also had a break of a trend line prior to the Brexit result as another little indication of weakness in the market. Of course, we had that big spike high when everyone thought that there was going to be a Remain vote, but it wasn't to be. The market had already kind of started to position for some weakness. And so then we finally get down to the environment down here where it's we have a brief pause, a consolidation, and eventually the first sign that maybe this downtrend starting to weaken, maybe about 120 was the bottom in the pound, is when you have this trend line break here. You pop above it, and then again we have another period of consolidation, and then there was actually a nice little trend line through here which connects the three lows quite well, basically denoting a sort of triangle pattern at the bottom really. And this was, this is the big week when we actually thought, actually no, we could be in for a period of higher prices here. So we broke this declining trend line and we shifted up, and now we're back into the same trend line environment that we just talked about at the start. No, this is why you can certainly use a logarithmic chart, and it makes a certain. Someone has just asked about a log chart. You can use log charts, and I would argue it probably makes sense on the longer time frames. I typically don't use log charts, so just stick with a simple default chart arrangement. So, excuse me. So, do these tools work? Well, you've seen me using it there, but the problem always is in these demonstrations, there's somewhat of a textbook example. Well, obviously, I've just gone back on the current price trend for the pound. I've tried not to, go and pick out perfect examples of trend lines for you, perfect examples of moving averages working where the moving average counts the bottom of the decline and uses the subsequent rise each time. I've tried to use a current price chart, but nonetheless, you know, even if we just scroll back on the pound price chart, you can see this has been a trending environment. But what about this? You know, the period between 2012, 2013. These techniques are at play, and there certainly are environments where you know, these tools are working well. But obviously, when there's not a crisp trend, you know, when you get the move, the break through the trend line, you get the move above the moving average crossover, they don't last as long. So this is not as good an environment for these techniques. So you always have to you know, try and juxtapose those techniques for determining the trend against the fact that, you know, maybe on a longer term basis, you know, we're just actually going sideways. Here we'd had a massive decline during the 2009 crash, 2008 crash, and then we turned into a big consolidation. So obviously that's normally the way things go, from range to trend to range again. So as I mentioned before, all of these tools add to your ability to determine the trend, but it's really using them together, or if you don't like one of these, maybe juxtaposing it with your own indicator, but putting them all together into a system is what helps you really get a clearer picture and makes things just a bit more objective. You know, the idea is that you have enough tools in your belt where you have a certain criteria of what needs to be in place. The moving averages have to be aligned a certain way, they have to be sloped a certain way, you have to be seeing higher lows and higher highs for an uptrend, etc. If some of those elements aren't in place and you're debating whether to buy or sell, you should know already, because your rules have said, based on these tools, based on these indicators, that you should be either a buyer or seller or neither. That's the idea here. So then finally, you know, how do I start using these techniques? Well, it takes a bit of time and takes a bit of effort, but really the first step is back testing. What you need to do here is, you know, okay, so I've gone through a bit of a back test for us live here, where I've looked at how these trend lines are working, how the breaks are working, how the moving averages are working. You need to go back through the price charts and look at as I've seen here, look at where you would have liked to buy or sell, where the dips were, where the breakouts were, etc., and see what clues the Dow theory, the moving averages, and the trend lines were giving you. And then the next step is forward testing those. Okay, so say they were giving you certain clues at the times you wanted to be buying or sometime thereafter. Start placing real trades, demo account or real account, as the case may be, and then recording those trades that you've done, and seeing how well these tools are working, and any kind of techniques that could need maybe configuring to your own style. So again, this was not a webinar on entry techniques or entry signals, actually placing trades. It was more just the first step of which direction do I want to be looking at for placing my trades. Do I want to take the buy signals, or do I want to take the sell signals? To know that, you need to know the direction of the trend. This was just 3 ways of determining that trend. So I hope that was useful. I think we've clocked a little bit over half an hour here, so a little bit longer than I was hoping, but I hope you got something from that, everyone. Apologies for the sound cutting out there. There will be a recording to be able to rewatch this again later, should it need be. All right, thank you everyone for watching, much appreciated. Jasper signing out.